Hello everyone, welcome back to pricing. Today's topic is incremental breakeven analysis. In this lecture, we're going to cover two things. One, what is incremental breakeven analysis? And two, how do we conduct an incremental breakeven analysis? This topic is particularly relevant when a company is making a decision on whether to and how much to adjust its prices. To motivate today's topic, let me start with a question. We have three very large companies, Coca-Cola, Amazon, and Walmart. And the question is, let's say these three companies have the free rein to make price adjustments. Let's say they can sneakily increase the prices of all their products by 1% without consumers even noticing. That is, after they make the price adjustment, there's no change in demand. If they can do that, 1%, a tiny percentage of price change. What percentage does the profit of each of these companies change? So Coca-Cola, Walmart, and Amazon. Feel free to pause the video and write down your best guess answers. Welcome back. Here are the answers. With Coca-Cola, a 1% across-board price increase leads to approximately 5% profit increase. For Walmart, a 1% price increase leads to about 30% of the profit increase. And for Amazon, a 1% price increase leads to about 60% of the profit increase. So you may be asking, why such drastic differences for these three companies? What happened? The key point here is what matters for profitability is not price itself. It is the profit margin, that is, what percentage of your total revenue is actually your profit. So let me lay out the calculation for you. Let's say you have a company and the company's total revenue is $100. And this company, like Coca-Cola, has about 20% profit margin. So the cost is $80. And 100 minus 80 is 20. That's the company's profit. If the company can increase the price without having any impact on its demand, with 1% price increase, what we are going to see is simply $101. Now, the cost stays the same, and 101 minus 80, it becomes 21. So the company's profit went from $20 to $21. That's about 5% increase in profit. Now, let me give you a different scenario. This is actually very common among big box retailers. Their profit margin is very thin. So in this case, let's say the company has a 2% profit margin. Again, let me lay out the calculations. So you have $100 as the total revenue minus 98, that is the cost. And the profit the company brings in is $2. Now, again, if the company is able to increase the price by 1%, that's $101 minus 98. So that gives you a profit of $3. So the profit went from $2 to $3. A 1% price increase leads to a 50% profit increase. So as you can see, this simple example shows you vividly the companies that are operating on a low profit margin their profitability is very, very sensitive to price changes. All right, that's all about that example. Today's topic is somewhat related since we are going to look at profit margins. Now, let's come back to today's focal topic, incremental breakeven analysis. So first, what is incremental breakeven? The first thing I want to emphasize is incremental breakeven, IBE, is not breakeven. Generally speaking, when we talk about breakeven, we are focusing on the absolute value of profit or loss for a business. That is, when we talk about break-even, we're looking at a scenario where the profit is equal to the loss equals to zero. So it means a business has neither profit nor loss. That's break-even. But when we talk about incremental break-even, we're not looking at the absolute value of profit or loss. We're looking at the relative change of profits. So incremental break-even measures how much the sales or demand would have to increase to obtain the same profit from a price decrease. It analyzes a what-if scenario. If I increase or decrease the price by this much, then how much demand or sales have to change in order to compensate for that price drop? Let me show you an example. iPhone 1. When the original iPhone was first introduced in the market, the price was $599. 3 months later, Apple dropped the price to $399. Let's say the cost of production was about $200, not considering the subsidy from AT&T or all the miscellaneous fixed costs. The question is, what percentage does the demand have to go up for Apple to maintain the same profit level when dropping the price? In order to do this calculation, first let me show you graphically how such changes look like. All right, so here's an illustration of how companies are making profit. If you look at this illustration, the horizontal axis is unit sales, and the vertical axis are unit variable cost and the price. And when you look at these rectangles, you can see that the green block here is contribution margin. That is the price minus the variable cost and the times the unit sales. That green square is what gives us the total contribution margin from price. And the brown square is the total cost. Now, if the company decides to make changes in price, what happens? When price decreases, if the company drops price, what happens is with price drop, we would expect demand to increase. The demand would move out. Between these two changes, what we are going to see is the new scenario, the profit moves to here and the cost becomes this block. There are two changes. One is the loss of contribution margin. When we drop the price, our bar is lower, so we are losing this orange segment. But on the other hand, because of the sales or demand increase, we actually gain a block in profitability because of demand. An incremental break-even analysis is designed to examine the trade-off between the loss of contribution margin and the gain of demand. When these two blocks are equal to each other, we call this scenario incremental break-even. That is, the profit stays the same because the loss and the gain, they are equal to each other. Now, that's the scenario when the price decreases. What about if we increase the price? So when we increase the price, we actually gain from contribution margin. But because of the price increase, we expect the demand or unit sales to drop. So the unit sales moves to the left. And in this case, we are having a thinner profit and cost structure. And here, the gain is from the price increase that leads to a gain of the contribution margin. And the loss is from the loss of demand. Again, we're going to compare these two blocks of gains versus losses. And we say that when the gain is equal to the loss, the profit stays the same. We call that scenario incremental breakeven. So I hope these graphs can help you understand the scenario more intuitively. And next, we're looking at how exactly do we use numbers to analyze a incremental break-even scenario and calculate the demand needed to stay incremental break-even. So here's the formula that we use for calculating incremental break-even. Profit equals, so the price minus the variable cost times the demand, and then minus the total fixed cost. So that's the profit for a business. So what we are looking at when calculating incremental break-even is we are considering the scenario where the profit would stay the same. That is, the profit before the price or cost change, profit 0, is equal to profit 1, that is the profit after the price or cost change. Now let's apply this calculation to the example that we have talked about. So the calculation goes like this. First, we want to introduce a scenario where profit 0, profit before the price change, equals profit 1, that is the profit after the price change for iPhone 1. And in this case, because there's no fixed cost change, we don't have to calculate that part. So when you lay out this function, what you have is $5.99 minus 200 times the unit sales 0, before the price change is equal to $3.99 minus 200 and times the unit sales 1, that is the unit sales after the price change. And to calculate these numbers, so we can first calculate the profit margins for both before and after, and then we transform the equation. What we are getting at is basically the sales after the price change is equal to slightly over twice the sales before the price change. And so what percentage does demand have to go up for Apple to maintain the same profit level? So in order to calculate the percentage, we have sales 1 minus sales 0 divided by sales 0. And in this case, based on what we have, we can find that at the end of the day, the demand has to go up by 101% for Apple to maintain the same profit level when they drop the price. In reality, usually your price drop is not a point decision. That is, you want to consider a range of potential price changes. So we have calculated the price drop from $5.99 to $3.99. And in reality, Apple may want to calculate the price drop to $4.99 and all the way down to $2.99. In the spreadsheet on the next slide, I'm going to show you a range of price changes. In this table, the bar in the middle is the baseline scenario where the price is $5.99 before the price change. And above this bar are the price increases, $6.99, $7.99, $8.99. Below this bar are the price decreases, $4.99, $3.99, and $2.99. And we have already calculated the price drop to $3.99, which corresponds to 101% increase in terms of break-even sales. So what we have done in this table is basically repeating the incremental break-even analysis we have done for the 399 case, but for all the other price level changes. In order to demonstrate this, I have laid out what we call a ISO profit, that is the equal profit curve in terms of incremental break-even sales. So what we are looking at is 599. This is the baseline scenario in the middle of the curve. And towards the right are price increases, towards the left are price decreases. So the horizontal axis are different price levels. The vertical axis illustrates at each hypothetical price scenario what are the incremental break-even sales volumes. The baseline is 100%. That is, when you decrease the price from $5.99 to $4.99, you're going to see an increase in your incremental break-even sales volume. One thing that you should take home is this curve is not a straight line. This curve is very similar to what we have discussed in the example about the three companies, Coca-Cola, Amazon, and Walmart. When you decrease price further, the company's incremental break-even demand becomes very sensitive to price decreases. You will need a very large demand change in order to compensate for the same level of price decreases. And on the increasing end, the opposite is true. Let's look at a second example, Lala Kitchen breakfast. Lala Kitchen has decided to cut the price for breakfast from $4.99 to $4.49. The restaurant currently sells 1,000 breakfasts a day. If the unit variable cost drops from $150 to $120, what is the minimal increase in sales necessary for the profit level not to decrease? The calculation is very similar to the previous example we have. So profit 0 equals profit 1. And then we go ahead to specify the profit before and after the price change. In this case, with variable cost change as well. And the rest of the calculations are relatively straightforward. So just lay out the profit margins times the sales. And we know the sales before price change is 1,000 units. This gives us new sales of 1,060.79. Round up to 61. All right, let's recap. So today we have covered the incremental break-even analysis. Incremental break-even analysis tells us the impact of price adjustments on the necessary demand change in order to maintain a certain targeted profit level. So it is very useful. It gives us a what-if scenario for price changes. What we should expect or what we should work on in order to maintain that level of demand. It is important to keep in mind that incremental break-even analysis does not tell us how much demand will actually change. That we will have to examine the demand curve in the market. So this is a what-if analysis. If you expand the IBE into multiple price points, so what if you change the price to 5, 6, 7 different price levels, and then you can use that for a scenario analysis and find out what are the demand levels you need to maintain in order to retain the same level of profitability. Here's some additional hint for the assignment. First, we lay out the condition for incremental breakeven analysis that the profit doesn't change. If you substitute the profit formula to the before and after condition for profit 0 and profit 1, this is what you have. Notice that I've put fixed costs here. However, in the examples, I didn't leave fixed costs in. The reason is when fixed cost does not change, they cancel each other out in this equation. You can always leave the same fixed cost in your calculations. It will not make a difference. However, if the fixed cost changes, then you should leave the fixed cost in your calculations, because they no longer cancel each other out. I hope this is helpful. That's our discussion on incremental breakeven analysis. I'll see you next time.